Good day, everyone, and welcome to the premium video newsletter for Monday, August 5th, 2013. We have lots of new members who joined our group over the weekend, and I'd like to welcome each and every one of you to our premium membership program. We have lots of exciting developments in the market today, mostly from a technical perspective. Starting with the fundamentals. Today we had the Institute of Supply Management report earlier announced that its non-manufacturing purchasing managers index rose to 56 in July from a 3-year low of 52.2 in June. Analysts had expected the index to rise to 53 last month. An increase in new orders drove gains, with the new orders components of the index rising to 57.7 from 50.8 in June. Typically, a reading above 50 signals economic expansion, so the number was positive even though it didn't beat expectations. The stock market was not very affected by the economic news this morning and was quiet for most of the session today. I'm not expecting too much volatility till later part of the week when the jobless claims are released on Thursday before the open. Till then, it's earnings and technicals that'll be driving the stock market primarily. The S&P had a very tight range-bound day today with very little volatility and volume, which is very characteristic of a typical summer trading day. The small cap stocks did continue the momentum to the upside in early morning trading, which is impressive because the small caps are more speculative, and I would assume we would be more cautious near these levels. But we did make a new high on this sector, and small caps have been leading the market for the last several weeks. So we will continue monitoring them at least till the end of summer to see if they continue to lead the market. What's weighting down the broad market is the financial sector. The earnings in this sector were not that impressive, and the financial sector is most affected by the threat of the Fed's $85 billion infusion into the stock market being terminated, and is very sensitive to rising interest rates. So there's a good reason why we're not seeing a rally in this sector for now. I think if we have some really strong improvements in the economy, this sector will be holding down the broad market from continued momentum to the upside in the next few months. We are seeing momentum really picking up in the tech sector. If you recall a few weeks ago, the tech sector was lagging due to the negative news we saw from a few of the large cap stocks, such as NASDAQ. But now the techs are leading. According to very extensive backtests, technology stocks do tend to lead the market about 60% of the time. And it looks like the techs are taking the lead once again. The only subsector that's giving technology trouble is the semiconductor sector, which is only getting tighter and tighter during the last few days. The symmetrical triangle that we are seeing right now will pop. And to me, it looks like it's going to be moving lower because nothing has been able to make this sector rally in the last few weeks, not even NASDAQ market making new highs, which is very bullish because large funds tend to increase buy programs during market breakouts and purchase large basket of stocks. But with the holidays, we're not seeing too many buy programs, and semiconductors are just not budging. I will continue to monitor this sector as well as this ETF, and if we begin breaking down, I will notify you as soon as I see it. The bond market is continuing its range-bound trading action as discussed late last week. For those traders who do not trade futures, you can look at the UST ETF or TLH ETF, which tracks this market very closely. This is a great time to short this market because I'm not anticipating too much volatility till Thursday's jobless claim report. So we still have a few days. My short-term target is the 125 area, and my stop loss is near the 127.5 level. Keep something in mind. I'm long-term bearish on bonds, so I'm only taking this trade to the downside. Even though the market is range-bound and choppy, I still want to be in the direction of the main trend. So when you do trade range-bound markets, make sure you only take trades in the direction of the main trend. It will save you in the long run when market turns against you sharply, because as I always say, markets tend to resolve themselves in the direction of the main trend. The next market I want to take a look at is the gold market. And many of you know I'm also very bearish on the gold market long term. I can tell you stories when I was buying gold options when gold was at 250, but that's for another time and day. During the last few months, I've been convincing anyone who would listen that gold is going to move from the 1250 to the 1300, 1350 level. And once it moved above 1300, I've been patiently waiting for it to move to the next level. And we almost hit the 1350 level almost 2 weeks ago. I began selling, and I think we're going to start heading lower. Let's see how the next few days go. The next support level is back down to the 1250 level, and we will see how the market reacts at that point. Remember, for those of you who don't trade spot metals, there's an ETF that tracks this market perfectly. Its ticker symbol is GLD. Lastly, before we go to the setups, I want to bring the yen to your attention. I'm concerned with whether or not we're going to break the low here. Remember what I've been saying for the last few weeks. I'm not concerned with the upside here. I'm concerned with the downside. This market will go higher if it creates stronger support. But we're at the support line right now. So let's see if we can bounce off or break it. The 1.025 area is the next level to watch. And if we can take out that level, there's very little upside resistance. So I'm watching this market carefully. If you trade ETFs instead of Forex or futures, send me a quick email and I'll give you a good ETF that tracks the yen perfectly. I've been talking to many traders who are switching back to ETFs from Forex markets during the last several months so that they can trade everything from their stock account. There's an inside day long setup on ticker symbol BDC. Place a buy stop 10 cents above today's high, and if filled, place a sell stop 10 cents below today's low price. There's also a short 4x4 sell setup on ticker LNN. Place a sell stop 10 cents below today's low, and if filled, place a protective buy stop 10 cents above today's high. We will cover some trades with volatility stops later in the week. Have a great night, everyone, and I will touch base with you tomorrow morning.